There. Today, our team recommends that the Federal Open Market Committee hold the federal funds rate at its current target rate. You can see that over the past several quarters, rates have plateaued and begun moving gradually lower from their peak. Maintaining this position continues to exert downward pressure on inflation without risking unnecessary tightening that could weaken the labor market further. We will evaluate many key components. Together, these indicators guide our recommendation to hold rates at their current level. The labor market remains resilient, but all indicators suggest cooling. This gradual cooling reduces wage pressure inflation. It is important to note that publication of September data was delayed by more than 6 weeks because of a lapse in federal appropriations due to the government shutdown. This chart shows the unemployment rate from September 2023 through September 2025. We see a clear upward trend. Unemployment has risen from just above 3.5% to about 4.4%. While this isn't alarming yet, it signals that the labor market is loosening. Additional rate hikes could accelerate this rise. Month-to-month changes in non-farm payroll employment displays the spikes in early 2024 taper off into much lower monthly gains by mid-2025, and several months approach zero. This volatility and downward trend signals show slowing hiring momentum. Again, the labor market remains functional, but it is clearly cooling. Labor force participation remains generally stable. This means that softening in unemployment is not driven by workers exiting the workforce, but by weakening demand labor, signaling that the current rates are already restrictive enough. The job openings and labor turnover survey shows hires, separations, and job openings. Shown by the major trend is the sharp decline in job openings, shown by the top line dropping significantly from its post-pandemic peak. Lower quits and lower openings indicate decline in labor demand. Since wage growth often slows when openings fall, this helps cool inflation. Next, we look at financial markets. The yield curve, market expectations, and credit conditions. All three shows signs of financial restraint. This yield curve chart shows an inversion in U.S. Treasury yields as of July 2025. Short-term yields remain higher than long-term yields. An inverted curve traditionally reflects recession risk and market expectations of future rate cuts. Raising rates in this environment could further invert the curve and increase recession risk, so holding steady is the safer choice. Here we see the historical 10-year minus 2-year spread, which is often used as a recession signal. The spread remains negative in 2025, reflecting ongoing caution in financial markets. Market pricing suggests that monetary policy is already sufficiently restrictive. This chart illustrates the net percentage of banks tightening lending standards for commercial and industrial loans. Tightening is elevated, meaning banks are already restricting credit to households and businesses. Since bank tightening acts like additional rate hikes, the financial system is effectively tightening even without the Fed increase in rates. In the banking system, we see ongoing risks, particularly around deposits, unrealized losses, and commercial real estate exposure. This chart shows the unrealized gains and losses of bank security portfolios. Losses increased sharply in 2022 and 2023 and remain significant in 2025. Higher rates worsen these losses. Holding rates prevents additional pressure on banks on bank balance sheets and lowers the risk of more regional bank instability. This chart shows commercial real estate mortgages maturing through 2030, with a major spike around 2026. CRE loans must be refinanced at much higher rates than when they originated. That increases default risk for banks already holding unrealized losses. Holding rates prevent stress in this sector. Market sentiment reflects a cautious environment. Equities are recovering, but rate sensitive. Bond volatility remains elevated, and credit spreads show widening risk premiums. This chart shows year-to-date S&P 500 sector returns through October 2025. Growth sectors like tech and communications are strong, but economically sensitive sectors such as energy, real estate, and consumer staples lag. This divergence shows markets expect slower economic growth. The MOVE index measures Treasury market volatility. Although it has come down from earlier peaks, it remains elevated compared to the pre-pandemic norms. Higher volatility reflects uncertainty about the economic outlook. Credit spreads, especially high yield spreads, remain wider than earlier in the cycle. This shows investors are demanding more compensation for risk. Widening spreads signal tightening financial conditions, again acting as a substitute for rate hikes. Since markets are already tightening, the Fed should hold rather than risk amplifying financial stress.
All right, and then I'm going to be starting with inflation and price level, which includes headline and core inflation, as well as sector breakdown and inflation expectations. So this chart shows headline inflation using the all items CPI. Right now, inflation is running about 3% year over year, which is a big improvement from the peak in 2022, but still above the Fed's 2% target. You can see inflation has flattened out over the last several months. We're not seeing major month-to-month spikes anymore, but we also aren't back to fully pre-pandemic levels. A lot of the remaining pressure in headline CPI comes from shelter and energy, while goods inflation is mostly cooled off. Overall, the headline inflation is moving in the right direction, but the progress has slowed. This slide focuses on core inflation, which excludes food and energy. Core CPI is sitting just under 3%, which shows some cooling, but also a clear plateau. The important point here is that core inflation is being held up by the services sector, things like insurance, medical care, and especially shelter, which all move more slowly and tend to be sticky. Goods inflation has come down significantly, but services are still keeping core CPI above the Fed's target. This is why the Fed remains cautious and hasn't declared victory yet. Here we're looking at core PCE, which is the Fed's preferred inflation measure. It's tracking around 2.7 to 2.9%, slightly softer than core CPI. What stands out in this long-term view is how smooth core PCE tends to be. It doesn't swing as aggressively as CPI. The trend shows a clear decline from the 2022 highs, but similar to the CPI slides, the recent months show more of a slow drift downward instead of a rapid progress. For the Fed, core PCE is the metric that really determines policy decisions, and right now it's close, but just not close enough to justify a deep rate cut. So here we're looking at sticky and flexible inflation. Flexible prices, mostly goods, gas, and airfare, have come down sharply and are a lot closer to that 2% mark. Sticky prices, which include rent, insurance, and other slower moving services, are still running above 3%. Those categories don't adjust quickly, and they're the main reason inflation hasn't fully normalized. The key message here is that the remaining inflation problem is concentrated in just a few slow-moving service sectors. That's why the last mile of disinflation takes the longest. Here we have the CPI components broken down across categories. Shelter remains the largest driver of inflation, although it started cooling. Food inflation is running around 3%, while energy has become more volatile again. You can also see that most goods categories have flattened, which is why overall inflation has come down so much from 2022. This breakdown reinforces that inflation today is not broad-based. It's being held up almost entirely by services. Here we're looking at the consumer inflation expectations from the University of Michigan. 1-year expectations have jumped into the 4 to 4.5% range, which tells us households still feel the effect of higher prices even though the inflation has slowed. These short-term expectations matter because if consumers expect higher inflation, it can influence wage demands and spending behavior. Even though actual inflation numbers are lower, consumer sentiment is still being shaped by the last 2 years or so of price increases. The 5-year break-even inflation rate, which comes from treasury markets, paints a very different picture. This measure is sitting around 2.2 to 2.3%, which is almost exactly where the Fed wants long-term expectations to be anchored. The key takeaway is that financial markets are not worried about runway inflation. Investors believe inflation will settle near target over the long run. So while consumers may feel inflation in the short term, markets are signaling confidence in the Fed's long-term credibility. And now we're going to be looking at the real economy indicators like GDP growth, consumer spending, business investment trends, housing market, and manufacturing and services. So here we've got the most recent GDP breakdown. It's a little small, but GDP grew roughly 3.5 to 4%, which is a strong reading given current interest rates. The biggest driver is consumer spending, especially on services. Business investment is mixed. Intellectual property spending is strong, but equipment spending is slower. Housing remains a drag, but overall GDP performance shows an economy that is still expanding at a solid pace. Real PCE, which measures inflation adjusted consumer spending, shows a steady upward trend. Even with higher interest rates and reduced savings, consumers are still spending at a healthy pace. Goods spending has leveled off, but services spending, especially travel, healthcare, and recreation, continues rising. This is a major reason why GDP remains strong. The US consumer is still resilient. And then here we've got business investment trends. Business investment trends are telling a mixed story. Investment in intellectual property like software and R&D has remained strong, showing a lot of continued spending in tech and automation. But equipment investment has softened and some manufacturing related investment is slowing. Overall, businesses are still investing, but they're being more selective, prioritizing high return areas over broad expansion. And then as for the housing market, it's still struggling with high mortgage rates. Even though rates have come down slightly, they're still around 6 or 7%, which keeps affordability pretty low. The starts have slowed and existing home sales remain stuck near 4 million, far below the pre-pandemic levels. Despite weak activity, home prices are still rising moderately because inventory is extremely limited. Housing is one of the few consistent drags in this economy. And then this is showing the manufacturing PMI, which is sitting at 48.2%, below the 50 line that signals contraction. Manufacturing has been weak for months as businesses pull back on goods production and new orders. High borrowing costs and slower global demand contribute to the slowdown. The key message here is that the goods producing side of the economy is still struggling, even while overall GDP remains healthy. And then on the other side of the slide here, we've got the service PMI, which tells an opposite story. At 52.6%, services are still expanding. Since services make up almost 70% of the U.S. economy, the strength here is one of the main reasons that the economy continues to grow. Categories like business activity, new orders, and employment are all positive. Putting this together with the manufacturing graph, we see a clear split. Goods are weak, but services are still strong enough to keep the overall economy moving.
So now I'm going to talk about the global and geopolitical environment, which directly shapes US inflation and growth. So first, global demand on the conditions are soft. Europe remains closer to stagnation, and China's rebound is weaker than expected due to its property sector slowdown. And this reduced external demand for US export and slightly eases inflation of global pressures. Second, we face ongoing commodity risk, especially in energy market. OPEC supply constraints and geopolitical tension in the Middle East raise the probability of another oil price spike, which could quickly pass through into headline inflation. Finally, exchange rate dynamics matter. A stronger US dollar lowers import prices, which will help disinflate goods, but it also tightens financial conditions globally and could imply stress in emerging markets. Overall, the global environment is mixed. Weaker demand helps reduce inflation, but geopolitical risk keeps upside inflation pressures alive. So the first chart, where this chart basically shows that Euro area real GDP grew only 0.9% in 2024 after 0.4% in 2023, and quarterly growth in 2025 is running around 0.2% per quarter, which I think indicates very subdued demand from one of our key trading partners. And then the next chart, this one indicates that on the China side, industrial production growth slowed to 4.9% year over year in October 2025. down from 6.5% the month before, showing that momentum is weakening rather than accelerating. And then the next chart shows that Brent crude prices rose in early 2024, largely on geopolitical risk from Middle East conflict. And research from the ECB shows that geopolitical shocks can move oil prices both through supply concern and uncertainty about global demand. That means a renewed flare-up would quickly pass into headline inflation. And next chart shows the broad trade weighted dollar index is still well above its pre-pandemic average, which can reduce U.S. import prices but tighten also financial conditions for the rest of the world, adding to stress in the more leveraged economics. So now, when we assess risk around the baseline outlook, we must consider both upside inflation risk and downside growth risk. On the upside, inflation could reaccelerate IFFU energy prices spike due to geopolitical events. Additionally, wage growth remains elevated, and if productivity does not keep up, that could feed into persistent service sector inflation. Finally, shelter inflation remains sticky, even through new lease measures are cooling. The lag in CPI shelter data means this inflation may occur slower than expected. On the downside, several recessionary risks remain. Commercial real estate is under significant pressure from higher interest rates and weak office demand, raising the probability of a default wave, especially in regional banks. We are also seeing consumer delinquencies rising, especially in auto loans and also credit cards, which could weaken household demand, and global weaknesses, especially from Europe and China, could spill back into the US, demanding exports and confidence. Overall, the balance of risk remains two-sided, but with inflation risk still slightly tilted to the upside. So the first one, we already talked about this chart, but this Brent crude prices rose in early 24, largely on geopolitical risk from Middle East conflict. So this could mean that renewed flare-up would quickly pass into headline inflation. So we should look into it. But also the next chart, the Atlanta Fed's wage growth tracker shows that wage growth is off to peak, but still above typical pre-pandemic levels, which can mean labor cost pressuring could keep core services inflation stickier than the Fed would like. And then the next chart is showing the CPI shelter index is now around 418 in September 2025, far above its pre-pandemic level, but continued to rise slowly because of the way housing enters CPI with a lag. This component is likely to stay elevated even as market rentals cool, which is an important upside risk to core inflation. And next chart, this figure from the Federal Reserve's April 2025 Financial Stability Report. This shows that commercial real estate price after adjusting for inflation have fallen significantly since their 2022 peak and were largely flat entering 2025. This stagnation in real property values increase the probability of refinancing stress because borrowers must refinance at higher interest rate but with lower collateral values. So this dynamic heightens the risk of a commercial real estate default wave, particularly in the office sector where vacancy rates remain historically high. And next one, the New York Fed consumer credit data shows that credit card and auto loan delinquencies are now above pre-pandemic levels, especially for borrowers with lower credit scores, which points to growing stress among more vulnerable households. And next one, the IMF projects global growth about around 3.0 to 3.2% in 2025 and 2026, compared with 3.7% average from 2000 to 2019. So the world economy is expected to run below its pre-COVID trend. If that downside scenario is worse than expected, weaker external demand could spill back onto US export and business confidence.
All right, I'm going to be going over the policy options and our decision framework. Now, we have three broad choices on the policy rate. We could raise rates if we believe inflation is picking back up. We could hold where we are right now and let the data play out that we have, or we could cut rates back. Option one is to raise rates. The upside of that would be to show a commitment to keeping the policy rates tight while core and shelter inflation rates are still high. This leans against the labor market that's tight enough for wages to increase the given price pressure. The downside is that there are higher recession risks with growth already cooling and the yield curve inverted, plus more strain on banks, the CRE, and housing rates. This option makes sense if we see core and shelter inflation rates leveling off or possibly re-accelerating. Option two is to hold rates. The upside is that if policy rates stay clearly restrictive and we give past rate hikes more time to work through jobs and spending credit, that could work out well. The downside is if disinflation slows, we risk living with inflation a bit out of our comfort zone, a little bit higher than we like that. Also, we wouldn't offer much help if global growth or domestic data suddenly weakened. That would only be if it weakened. This option relies on the data we're seeing now as inflation is slowly easing, labor and activity are cooling, and the markets and credit are already tighter than normal. Option three is to cut rates. The upside is that a rate cut would act as insurance if growth and job rates weaken faster than we expect. The downside is that core and service inflation rates are still high, so early cuts risk increased price pressures. This could trigger easing in the financial conditions. Cutting rates would only be viable if there were a shift in our data, specifically in core, sticky inflation, and wage growth. And also if we start to see a decrease in jobs, spending, housing, or rising credit stress. Now, our final recommendation. We're deciding to hold the policy rates because inflation is easing and expectations look stable right now. But core, service, and shelter inflation rates are still slightly higher than we would like. Growth and job rates are cooling enough to watch, but not enough to justify a hike or rate cut. Credit, the CRE, and global growth rates are sensitive, so holding in this case avoids both tightening and sending in an early sign of easing. Data to be monitored going forward: inflation, core and service CPI, shelter, and sticky price measures, as well as expectation charts. Real activity, the GDP components, real PCE, business investment, housing and mortgage rates, and the manufacturing service industry. Financial conditions, the yield to curve slope, bank deposits and unrealized losses, CRE exposure, credit spreads, and the bond market volatility, as well as the global backdrop, the euro area growth, China industrial output, oil prices, and external demand. Thank you.